For the most part, it's not the crisis that matters, but the ordinary.
The hardest question, I suppose, that most investors want to know.
It's important for us to ask the hard questions. Hello, I am Monene Watson from Old Mutual Multi-Managers, and my topic today is how do we invest in a time of crisis? From time to time, the world and its financial markets will be rocked by crisis. In the past 2 years, we have had two such events, the COVID pandemic and the Russian invasion of Ukraine. These ongoing events continue to have an impact on economic growth and politics, much of which we cannot predict at this stage. So how should investors think about such crises? For the most part, it's not the crisis that matters, but the ordinary. Crises cause market volatility, but it is the day-to-day business of business, generating and growing profits that propel stock markets higher over time. So the trick is to stay invested and watch those returns compound over time. Crises by their nature are low probability, high impact events. They are almost always unexpected, even if there are warning signs. One just has to think back to the coronavirus. When it first emerged in Wuhan, few people believed it could become a global pandemic. And more recently, when Putin amassed his troops on the Ukrainian border, most people thought he was bluffing, even the experts. In other words, it's difficult to spot crises in advance, since most viruses don't cause pandemics, and most cases of geopolitical saber-rattling don't turn into war. In the realm of economic crises, we look for the buildup of imbalances. For instance, prior to the great financial crisis, there was simply too much debt everywhere. But almost no one can predict where the tipping point is, where things begin to spiral out of control. A key thing to note is that it is precisely when things have been going well, and going well for some time, that these risks accumulate in the financial system. So while we tend to be most worried after a big crisis is hit, from an investing point of view, it's better to be worried when the outlook seems very rosy and everyone is optimistic. So it's important to be alert to the risks, but we have to accept that our ability to spot these events in advance is really limited. This means that portfolios must always be positioned to be robust under many scenarios, not just one. Because the worst case scenario usually doesn't occur, neither does the best case scenario. Another thing to remember is that deep crises change the world and the way that people behave. People who grew up during the Great Depression famously were extremely thrifty and conservative with their money throughout their lives. We've yet to find out what the impact on behavior will be from COVID and the lockdowns. But one thing we already know is that work from home is here to stay. Another is that people are more likely to keep surplus supplies around for fear of running out of things. Crises create winners and losers. This creates investment opportunities if you can spot the winners early, but also if the losers have been punished too much by financial markets. However, when there's a big shift in behavior, it can easily lead to all kinds of hype that never materializes. One just has to look at the share price of Zoom. It surged during the early stages of lockdown for obvious reasons. But if we look at the share price now, 2 years later, you would have been much better off just owning a broad portfolio of shares. So since we lack the ability to predict crisis, what is critically important is how we respond to crises. One of the lessons from history is that markets usually recover much quicker than you can imagine. And importantly, the recovery starts long before things on the ground feel much better. A great example of this is the British stock market during World War II. It bottomed with the evacuation of Dunkirk in 1940, literally one of the darkest moments of the war. with victory over Germany still 5 long years away. Why? Because all of the bad news had already been discounted into the stock market, and from that point, things could only get better. And we saw something very similar in March 2020. The market recovered long before the pandemic and lockdowns were over. And in fact, the pandemic is still not over. So even if you are smart or lucky enough to get out of the market before it slumps, getting back in can prove to be extremely difficult, or if you're waiting for the dust to settle or for things to get better, some level of certainty. Of course, the worst response in most cases would have been to sell out of the market after it had fallen, and therefore locking in losses and missing out on the recovery. In 2020, investors who sold out after the crash suffered a second blow when interest rates were cut sharply, almost halving the return they could expect from what is perceived as safer investments in money market. So having said all of this, how can diversification help? There are 2 recent examples from the crises we've spoken about. During the COVID crisis in early 2020, the rand fell sharply as global investors panicked and dumped emerging market assets. This meant that the exchange rate limited the impact of weaker global markets from a South African point of view. If we look at what happened this quarter, the beginning of 2022, it was the complete opposite. As commodity prices surged in the wake of the Russian invasion of Ukraine, the rand, South African equities and bonds held up while global bonds and equities fell. This highlights another important point. Even if you could predict the event, predicting the market response is extremely difficult. Markets can behave in completely unexpected ways. So many people want to seek certainty, but there's a cost to that. The greater the certainty, the greater the desire for certainty. The greater the instability, the more we crave stability. This means that certainty and stability become much more expensive when we need it. And we can see this in the derivative markets as an example. But also in the fact that selling something after it has fallen in value and then buying something after it has increased in value is a very expensive way of running a portfolio. Finally, it's hardly necessary to point out, but the media thrives on conflict and crisis. They have every incentive to blow such global events out of proportion with wall-to-wall coverage and hype. One of the keys of successful investing is to tune out the noise and stay focused on the long-term strategy and what really matters. In the end, your own investment decisions will probably have a far greater impact on your lifetime returns than conflicts, pandemics, and political crises. It's our ability to stay calm when markets are volatile, to remain patient amidst screaming headlines that will determine investment success.